Trevor, we've talked before about how pension tax relief can be very valuable for UK taxpayers and those that are UK resident. As we know, for US citizens, often things aren't always as straightforward. When it comes to UK pensions and tax relief, how does that work for US connected individuals? Can they still obtain the relief on UK pensions?
Well, Rachel, there are no equivalent US tax breaks for UK pension plans per se. So personal contributions are not deductible. Any employer contributions would be taxable in the US. Now, that may not actually matter at the end of the day on a person's US tax return because of the operation of foreign tax credits. So you probably won't end up paying any additional US taxes. Then once the contribution is in the plan, then for US purposes, the amounts would roll up tax-free for US purposes. There'd only be a US tax point then when there's a distribution from the plan. But the big issue, the big problem, is that there are significant additional US filing obligations each and every year in respect of personal plans, be they self-employment plans or personally funded plans. So it can be quite expensive to deal with the accounting on the US side in respect of these plans, but it's even more expensive if one doesn't file the reports and then subjects oneself to the IRS penalties. There can be penalties up to 35% of contributions to the plans if one does not report that contribution to the IRS in the right manner.
And I guess a lot of the time, certainly in our experience, when clients come to us as new clients, it's often they're not reporting because they don't think that they even need to, otherwise they're just doing what everybody else that they work with is doing, either paying to their own pension or their employers.
Absolutely, it can come as quite a shock, quite a kind of a rude awakening to them. And in many situations we've had to go back to the past, correct prior non-filings. There are certain US IRS programs which will allow people to get back on track with any prior non-filings. They only have to file a handful of the most recent 3-year returns, for example, as opposed to going back for 5, 10, 15 years.
Yeah, but I suppose the key thing is if they are funding a pension and getting the UK relief, that they're taking advice on how to do it properly from a US angle as well.
Absolutely vital, otherwise that could be a very expensive omission.
And when it comes, just fast forwarding a little bit, Trevor, when it comes to retirement, if US connected individuals are then drawing down on their pension funds, whether it be while they're here in the UK or the US, how does that work? That's presumably a piece of cake?
Well, almost actually, funnily enough, Rachel. Here the answer is not at all bad. I mean, certainly to the extent that an individual can take out a lump sum from a UK plan tax-free, so the 25% element, then broadly speaking, if one files the return in the correct way in the US will recognise that 25% lump sum tax-free amount. It won't be taxed in the States. One word of caution, if somebody's living in a US state at the time, then that state may apply a tax liability. Prime example of that would be somebody living in California.
Okay. So you mentioned the lump sum, but obviously, as we know here in the UK, people may take a lump sum or they might decide to take some income or a bit of both. How does that work if somebody's taking regular, I think you call them periodic payments?
Yeah. If people are taking periodic amounts, it really depends upon where they're living. If you're living in the UK still, then broadly speaking, the UK will tax the periodic income. The US will tax it as well, but the US will give credit for the UK liability, so there'll be no net US tax.
Okay.
For a person who's moved back to the US when they start drawing down on their pension, then the UK won't tax it. The US will tax it, but the person may have basis in the plan. They may be able to utilise carried forward foreign tax credits, so it may not actually cost them the full level of US tax, so there may be some benefits there. Once again, very important to consider the state tax consequences as well.
And I suppose, as you alluded to, in terms of how it could be quite tax efficient in the States, that also depends on how it was reported and if it was done in a certain way back when, really.
Absolutely.
So, yeah.
You really do need a joined-up solution for this.
Yeah. Okay. So I guess with many of the changes, whether it be for UK or US citizens, there are obviously opportunities there from a planning point of view, but I think you probably agree from when it comes to the US side, it's very much a case of taking advice on an individual basis and your future plans really before deciding whether it's to fund pensions or to draw from them.
Absolutely, opportunities, potential pitfalls. Every situation is different, as you say. There's no one size fits all answer here. The real advice is ask an expert.
Okay, which I'm guessing is you, Trevor.
Is the correct answer.
Thank you, Trevor.